All right, guys, we're back again. Another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Today, we got the big Russian with us, Mike Zlotnik, TF Management Group, Tempo Growth Fund, Tempo Income Fund. We got the Big Mike. Make sure you guys check out the Big Mike podcast, too. I featured on there. We're going to get into a pretty much high-level discussion today. I have a mathematician on. I'm just kidding. Thanks for coming on the show, Mike. I had you on before. Just give the audience a little background. How you got your start in real estate, and how did you make the transition to being a fund manager? And then we'll jump right into it. Thanks for coming to the show, man. Happy New Year.
Happy New Year. Thank you, Fuquan, for having me on the show. Yeah, and I go as a Big Mike. Now being Big Russian is not very popular with the war in Ukraine. So just to be clear, I don't consider it Russian war. I consider it Putin's war against people of Ukraine. But that aside, I'm originally actually from Moldova, just to be for the record. But and Moldova is a small republic actually to the west of Ukraine, if you look at the map. But that aside, let's go to real estate. So how did I get involved in real estate? I live in New York City, so my whole journey in real estate has been started in New York. I discovered real estate by buying apartments here in Brooklyn. And I was, my first apartment I bought in 2000. And it was always, well, most folks buy their first investment is their primary residence. So that's what I bought my first apartment where I lived in. From that point on, I started buying apartments in Brooklyn, and I discovered that it is actually a great appreciating investment. And I added some multifamily houses also in Brooklyn. So for a while, I was only investing in Brooklyn. And I was doing it passively for multiple years, from 2000 until 2009, when I went full-time into real estate. And the transition was almost natural. I had a technology career, successful career, almost 15 years. And I was burnt out. I was tired, and I wanted to do something that I really liked to do. And my passion was always real estate. Since 2000, I saw the appreciation. New York City is notorious for high appreciation. For years, New York City appreciated, I want to say, around 10% a year. As crazy as it sounds, but that's what it felt like. And with that kind of rates of appreciation, it's not difficult to make money. The cash flow was never too exciting, but the appreciation has always been the play in New York. And then 2009, I made transition full-time to real estate investing and never looked back. So I don't know if that gives you an overview, but that's kind of the history. And I've been in fund management, commercial real estate ever since. So it's been a journey.
Yeah, so you came in after the market crash, and I guess during that transition, you had a great opportunity to get a lot of good deals, because we were, in pretty much leveled out, and then that's where the opportunity was at, right? Sort of what I see could possibly be in the near future, right? Everybody's hanging on and saying, okay, we're starting to see in certain parts of the U.S. price dropping. Of course, it starts from the west to the east. But I was reading something in Market Watch, and it said the Northeast is still the strongest in values, right? Where we are, New York, New Jersey. I know you invest in different deals nationwide, but people's waiting for that opportunity. They're sitting on the sidelines. They're waiting. And sometimes I've known people who predicted 19 crashes and maybe 2 happened. So what is your take on that for people who have capital sitting on the sidelines, right? I'm trying to think of it from a fund manager perspective, right? You're seeing the deals, you're seeing the opportunities. You know that it's really about the sponsor, operator, their skill set, their ability to pivot, and navigate through these markets. But what is your take on people who's waiting for the great opportunity with idle capital sitting on the sideline in this current market?
Sure. So it's a great question, Fuquan. I'll answer the question first, and then I'll elaborate a little bit more. So there are 2 problems at hand. One problem, which a lot of investors are trying to solve, is they've got an existing portfolio, and how is that portfolio going to fare during a downturn? That is a legitimate question, legitimate concern, which requires a separate conversation. And then question number two is where to put fresh money. So in the underlying what the accompanying question is, should I invest now or should I invest later? Should I sit and wait for perfect timing, or can I take some action now? And the answer is it depends. So from the macroeconomic standpoint, we know we're going to recession. That is given. Q3, Q4 2023 is expected to be formally recessionary quarters. So Q1, Q2 may still see some momentum from good economy that's been around for a number of years, but we're certainly going into a downtrend. Number of markets have already softened, no question about that. So cyclical markets, and there's a big difference between, you mentioned Northeast. Northeast is generally non-cyclical, although there are parts of Northeast that are cyclical. So it depends. Northeast is less cyclical than some of the southern markets. So generally, the cyclical markets are your Phoenixes of the world, your Las Vegases of the world, your Southern California, your Southern Florida. Those markets are generally known to fluctuate a lot more when the economy is up, and then they fall when the economy is down. And then the Midwest, for example, is a very steady Eddie market. So those markets expect to correct a lot less. So the market obviously matters. But in general, the decision tree in this environment is as following, right? If you sit on your hands and you sit in your capital and you wait for perfect timing, how do you know that it's perfect timing? How do you know it's perfect deal? So it's very difficult to time the market. Can you start deploying some capital in early parts of 2023 on great deals? Absolutely. So the answer is you may see some really good deals starting to come as soon as now. We've already seen some deals where we've been able to invest and renegotiate with the seller substantial discounts. So what's happening right now, if you have a deal in the contract, you can come back and renegotiate, retrade. And if you're looking to invest in new deals, there are distressed situations that are happening. And one of the biggest drivers of distress, by the way, in commercial real estate, some of it will be true, obviously, in residential too, but in commercial, it's the bridge loan maturity or rate cap expiration. So there are plenty of loans that have been made 2-3 years ago when the rates were 3.5%, 4%. And now on renewal, they're jumping up to 6.5%. That is a massive pressure point for the owners of the properties. And if they can't raise additional capital or their rents haven't gone up enough, they're going to take, the problem is going to be, they're going to be short capital. And that problem is going to hit quite a bit of operators. What's really interesting is in 2023, about 450 billion of these loans expected to mature. It's a humongous number. So that will create distress. Some owners will be able to get investors to participate in a capital call. Some owners will be able to get fresh investor capital to participate. Some owners will be forced to sell. And if they're forced to sell, it could be distressed sales. So there's expectation that the market will start showing signs of distressed transactions over time, and maybe greater opportunity will open up. Can that opportunity be in a month? Absolutely. If somebody is distressed and their loan is maturing in a month, and if they don't sell the property, the bank will jack up the rate for them and call technical default because they can't service the debt. So there's all kinds of possibilities that will start happening sooner rather than later. But in theory, second half of 2023 could present somewhat better opportunities than the first half. I don't know. I hope I answered your question. And then I can.
Yeah, you did. You did. And thanks a lot. I mean, I think that the way to navigate through this market is to be a prudent investor, right? Is to have the correct type of leverage set up, right? The correct debt structure. And having those tenants, if you're in multifamily or whatever you're in, storage, whatever those tenants, residents are, paying on time to keep that cash flow going. You got good leverage and you can keep it stabilized. I think that's the key. Whatever you can do to keep it stabilized and navigate through the next 24 months, you should be okay. Those guys who took mezzanine financing and bridge debt and whatever they could to close a deal just to get those points, those management fees. They're gonna probably pay those back and some on the exit.
Yeah, and again, now we are sort of going into the second part of the conversation, that is what to do with existing investments. So the first question I try to address is upcoming deals. And then the other really important point, and I think I heard you say this. What's most important is folks you invest with. It's not the project. It's you start always with people. So for your audience, if they're investing with Fuquan, they shouldn't suddenly run to the next guy in the block because they have a bright and shiny objects, pretty looking deal, and they claim it this is a great distressed property sale. The exercise is really, what can we do? What more can we do with Fuquan? Why? Because we know, like, and trust Fuquan, because he knows what he's doing. So this is by far not number one point. We only invest with people we know, like, and trust. No matter how exciting the deal looks, we will never write a check as a fund manager into any deal unless we know the operator and we have track record history working with it. So now let me go into the first exercise, the portfolio management exercise, right? Some folks have done well putting together the right financial structures a few years ago, and they're not going to be dealing with that term expiration. They bought a property with long-term debt. The rates can go up, but if you have a fixed rate debt, it doesn't matter. The folks that have taken bridge loans, which is pretty common on value add projects. This is one of the big challenges. When you buy value add, you don't want to go directly to Fannie and Freddie and get a long-term product because you can't get the loan that you want. So people took bridge loans so they can execute value add, renovate units, improve rent, increase rents. Some folks have done well in that exercise, and they may be able to withstand the problem that they're going to face on the loan renewal. So again, the math is really, really simple. It's very easy to see. If you took a bridge loan and your rate was 3.5% from a few years ago when the Fed funds rate was 0 or a quarter, right? And now the renewal rate on a mortgage, if you go for a similar commercial multi-year mortgage, not a bridge loan, but a Fannie Freddie product, and you're facing 6%, right? You're going up from 3.5 to 6. Your debt service is up 70%, 80%. How much rent have you increased through your renovations and improvement, right? Pretty basic stuff. Well, you're up 40%. That's wonderful. You've done a great job renovating these apartments and increasing rents. But your mortgage payment is going to be up 70, 80%. This is the problem. This is where, in theory, it's supposed to reprice the market. So, and we don't know. We did lots of things depend. But if the market corrects, we may see 20 to 30% corrections in the values of these assets to be able to bring things in line with what rents have grown versus what the cost of financing is like. So existing portfolio, you can't really, you could lose your sleep at night and worry about it. You can do kind of a mathematical exercise. Really, you basically go through every investment you made and look through operating updates. Is it making the progress the way it was supposed to making the progress? It's pro forma. So is it increasing the rents? Is it renovating units at the pace that they were supposed to renovate? Are they increasing the rents to the targets, right? You can actually understand that part. How is it doing? Is it on plan, behind the plan, or ahead of the plan? Right? Hopefully ahead of the plan. The second thing that folks can do is obviously ask the investor that they've written them a check, the sponsor, what's happening with the mortgage? Do you have a mortgage term maturity? Do you see a potential need for a capital call? Right? So you can actually get a little bit of forward understanding when the cash will be needed and how much. And a prudent sponsors and operators are going through their portfolios now and basically looking at these investments and saying, this one will mature in 6 months. And when it matures, if the rates stay where they are, we're going to have a shortage of the capital because the debt service coverage ratio of 1.2, in order for me to meet that with the current cash flow, I need to inject another $500,000 of capital, right? That's just an example. So that exercise is a proactive exercise and folks should kind of think through. So in order to sleep well, in order to prepare well, investors and sponsors should go to the exercise and just think it through what's going to happen. because hoping and praying that at some point the Fed will start lowering interest rates. It's a great hope. But it's not realistic. It's not going to happen from what we are seeing out there. By the way, just one comment on the likelihood of interest rates going up and coming down again soon. Well, they're going to go up some more. I think there's another probably 75 basis points, maybe one or two more increases that the Fed will execute. And then at that point, they'll flatline. They'll flatline for anywhere between the Fed's funds rate of 5 to 5.25. That's sort of my view. The 10-year Treasury and the mortgage rates probably not going to go up as much, because the short-term paper, the 1 or 2 year or 3 months, 6 months will reflect that fluctuation. But long-term rates, I think they probably stabilize in my view, between 3.5% and 4%. That's the Treasury, right? And then the mortgage rate the mortgage has a certain offset of a couple hundred basis points offset. So your mortgage rate probably is going to look like 6.75, somewhere around there, maybe 6.5, maybe it depends on the product. So I hope it helps. So the thought process is, depending on what you got. If you got a big portfolio today, you need to do the exercise of going through your investments and figure out what's at risk, what's probably doing absolutely fine, and investments that are at risk, what do you need to do to protect them on a long-term basis. Some capital injection might buy time, and the interest rate may cycle back down in 24, 25, and when it happens, people can refinance again. But in the meanwhile, the storm is brewing. And the storm is not that the Fed will push the rates up much more. They've already done the damage. They've done the Fast and the Furious. If you look at history, they've never done this type of increase this fast. And not only on the absolute terms, it's on relative terms. We went from 0 to 4.5 in 9 months. This is the problem. It's the speed and the entry point that they started, and a lot of real estate investors and a lot of corporations have borrowed money a couple of years ago at the rate substantially lower, and they couldn't possibly foresee that the rates would go up so much so fast.
Yeah, that's weird. So there's a few things that you mentioned I just want to circle back on. First of all, is the timeline. So I am preparing, my team and I should say, we're preparing for the next 24 months to be, I won't say doom and gloom, but more like it is now, with rates increasing, and just this period. I believe it's going to be a 24-month transition. I'm thinking maybe somewhere around Q4 of 2024 things would normalize. So we're preparing to go through these next 24 months. Now, over those next 24 months, there's going to be some opportunities, as you mentioned, with this short-term money bridge financing come into play, or the mezzanine financing, or whatever creative financing that was done to get these deals. A lot of this inventory is going to come. So having that war chest, or having those private investors ready to pounce it's going to be like 2009, 2010 all over again, where you get the chance to re-up on inventory, stabilize it, and just wait, time after that to kind of maybe refinance it, hold on to it and cash flow it, or sell it, whatever you choose. What do you think that timeline is going to be? Are you and your team preparing for the next 24 months, next 12 months? Like how are you looking at that as far as a timeline of what we're going through?
Yeah, Juan, it's a great question. And I think it's pretty much in line with what we are thinking. As I mentioned, the first half of 2023 is not yet recession. It's a slowing economy, that there will be some opportunities, but the crux of the recession will be second half of 23 and the following, probably most of 2024. Most recessions last between 12 and 18 months. So if we start a technical recession somewhere in Q3 of this year, and it lasts for 12 to 18 months, that takes you all the way to the end of 24. From a timing perspective, I think you got it right. From the opportunity perspective, again, none of this stuff is a turn on or turn off switch. It's a gradual process. So the good opportunities may show up in a month or two, and they may continue to show up for the following, say, 24 or even 30 months. So it depends on where, what type of asset, what type of a deal. For sure, keep your eyes and ears open, and then access to capital will be critical, of course. So what happens? Most investors can actually get nervous. They kind of they do the opposite. The crowd does the wrong. Well, the crowd mentality is when things are well, they invest a lot of money. And when things are not well, they shy away from the investments.
Correct.
It's the reverse that needs to happen.
Yes.
Folks need to be building up the war chest now and preparing to invest when the economy or the market is down. And that's the communications we are going to set as well. Actually, I've been invited to speak, not this weekend, but next weekend in front of investors. And that's the message that, expect the values to drop 20 to 30%, right? It's substantial correction. And we don't know that. In some markets, in some assets, they may not see even a 5% drop. And in some other markets and some other assets may drop 50%. We don't know that. But a correction of some sort is coming. And you have to be smart and opportunistic. And at that point of time, the cash will be the king. As far as what kind of deal, it depends. I mean, if you're a multifamily operator, you're going to be looking for multifamily assets. If you're a storage operator, you're going to be looking for storage assets. I would say most, because we run family of funds, we invest with a lot of these operators. We don't want a storage operator jumping into multifamily, multifamily jumping into retail, right? We want folks to stay focused on what they know best and just be ready. And we'll actually hear from them. We'll get a phone call and say, hey, Mike, I got an awesome deal on the contract. How do you know it's an awesome deal? Well, because look at this. It's so much discounted to the reconstruction cost. It's basically motivated seller situation. And you can go through the list of things why it's a good deal. It becomes pretty easy to understand why it's a good deal. So it's kind of important to basically invest with experts, specialists, people you know, like, and trust, and just be ready to go when the deal shows up. Because when they do show up, it's an opportunity to act fast. It's like this. I'm about to default on a mortgage, right? I'm going to go, or I've already hit the default, right? So remember the good old days of short sales, you were able to negotiate. I don't think we're going to see that kind of a distress. I don't think we're going to see 2008 type of a collapse in prices. But 20 to 30% discount may be substantial enough for really good opportunities to come forward. The other really important point I want to make, some folks have talked about where do you find good deals? And I can tell you the good deals are going to be not new construction, because you can't really get a big discount on a new construction price, right? You have to buy existing, you have to have a distressed situation. And I've heard from folks, well, I've got a great land development, I'm building a new asset, new class A in a phenomenal market. That's wonderful, but you can't get a discount to that. The cost to build is still going to be the cost to build. So you will basically, it's a momentum play that the market will continue to appreciate, right? But you just can't get a good deal. The good deal is New Jersey, for example, giving an example, in the markets you operate, or the good deal is certain Midwest markets, or it's a motivated seller situation. It may not be the entire market. It may be specific pockets or specific sellers or specific folks. The big difference between this time and 2008 and 9 is that time everything got hit, everything. This time it's going to be very selective, right? As I mentioned, one massive pressure point is that expiration of the mortgage maturity or rate cap maturity. That alone is a humongous pressure point. There will be other situations where an operator just can't execute value add work. They've struggled for other reasons, right? And then they will compound. But what I mentioned earlier, that this whole mortgage rate increase, it'll create so much distress that there will be a lot of deals, but it won't be an area driven. It'll be a specific seller. So this seller, their loan matured, but the right next door seller didn't mature, so they're perfectly good shape. Does that make sense?
Yeah, it makes perfect sense. I got one more question for you before we wrap it up. And this is going back to the investor mindset. So I'm an investor in this fund, and the sponsor or the fund manager has been performing really well. Nothing has really made the hairs on the back of my neck stand up, to have any doubts or concerns. But now we're in this market, and I'm starting to see my returns not be what I was promised. Now they're cumulative, of course, but I'm not seeing it was promised. I was promised a 10%, Mike, and I got my quarterly distribution, and it's 1.8. It's not 2.5. And I'm getting concerned. Like, what should be running through my mind is should I just say, okay, it's the market? They have communication coming to me, they're being transparent from an investor mindset. Should I be expecting wins all the time, or should I be expecting for returns to get lower? And then if so, what would be the minimum that where I would say, wow, I need to bail out of this, or am I going to take a loss? I mean, it's not like the stock market where you just get like completely wiped out. But you see, I'm trying to go with this made up situation.
Yeah, so investor expectations need to be reset. I hate to put it this way. I don't know how else to put it. So we've had some great run, and now the environment is cooling. We are entering a slower economic growth into negative growth, essentially recession point of view. And when it happens, returns come down. So,
but you promised me this return.
Well, I don't know who promises this return. Most of the managers have the PPM say, they list so many risks how you can lose all your money.
Yeah, the first 20 pages.
Yeah, and not only that, there's a target return, and it needs to be very clear. Target return is not a 1-year return; it's a long-term average number over many, many years. So if you're an investor with Fukwan and your returns somehow coming down a little bit, and you like Fukwan and you think he will do the right thing on a long-term basis, just stick with the program. And the easiest thing to do is to run for the fences and say, well, I want my redemption right now. Well, if a lot of people go run to Fukwan and say, I want my redemption right now, and then the fund doesn't have a lot of liquidity, you're going to tell them, hey guys, I apologize, but I can't redeem because the money is deployed on a bunch of real estate. Same thing happens with our funds. We definitely don't want to have any kind of run in the bank because somebody thinks, well, I've been making great return, 20% in the last, or 15% in the last couple of years, and I'm afraid now things are going to drop into single-digit territory. I don't want to live through this. Well, practical implications, depending what you invested in, you may have ability to withdraw or not. Syndications, you cannot. There's no withdrawal. There's no redemption mechanism. Closed-ended funds, no redemption mechanism. Open-ended funds have a redemption mechanism, but most fund managers, by the way, may choose, if they see sort of a form of a run on the bank or too many redemptions, to say, okay, we want to slow down the redemptions. Every manager doesn't have to redeem. They can actually stop the redemptions at any time and say too many redemptions will hurt the fund. So from a investor mentality perspective, I would say just don't panic. Prudent fund managers will persevere through this. The returns may come down a little bit during a recessionary environment. Cash on cash return may come down a little bit, but the overall long-term view, the fresh cash will get deployed to the same funds or new funds and create great ROI on the fresh money going into great deals. Existing deals, again, return expectations should come down. And this return comes in two forms. One is cash flow, two is appreciation, right? Pretty basic stuff.
Correct.
The cash on cash may be coming down for a couple of reasons. Recession means somewhat lower occupancy, somewhat lower rents, right? So recessions generally will mean there will be some top line, at least either top line growth slowdown, or maybe even negative growth or negative top line on the revenues. And then on the debt side, the reason I brought up the debt, it's a bigger problem. So knowing what happens with the debt of each syndication invested in or each deal, it matters, because if the debt rate resets on that investment, that reset will hurt the cash flow massively. So there will be situations where you may be getting cash on cash, say 10% right now. What's wonderful. But imagine that deal is leveraged with debt and debt is resetting. So you may have a situation where instead of 10% cash on cash, you may see 2% cash on cash. I hate to put it, or may have no distribution for a little bit. And the reason for this is because in order for the asset to survive, it'll need to have the cash to be able to service the debt. This is one of the points I wanted to mention, that folks may get, one of the strengths of the funds, they have diversification. So for most of the funds, they're not going to go from 10% distribution to 2%. That's highly unlikely. What you may see some slow down, because the funds have many assets. Not all assets are hit at the same time. Something may get hit, something may be doing great. And also depends on the vintage and the age of the fund, of the assets in the fund, right? So if you bought a bunch of properties years ago with long-term stable debt, you probably don't have a lot of issues. If there's some term maturity on the paper, that's something to think about. And again, if you are invested in syndication, you can ask the operator, the sponsor, what is the terminal loan? Do you foresee problems needing capital call? If you're invested in a fund, folks can come to us, and we actually go into the exercise right now in our funds to go through every investment. We have many of them, and communicating with the operator, trying to understand, is this at risk of a loan resetting or not? If it's not, wonderful. As far as selling, this is going to be really interesting, right? So there's still going to be an opportunity to sell into a market that may be weakening. So where I'm going with this is that as fund manager, because we're generally passive, we write checks and we don't make investment decisions. The operators that we invest with make the decisions. If you are one of these operators, you may have an appreciated asset in your hands that's worth a lot more money that you paid for it, but you foresee a renewal being painful on a cash flow basis, and you may choose to sell. By the way, we're seeing this in one of our files that is doing absolutely phenomenal. Just a great file, was bought right after COVID hit, and the value has gone up a lot. And one of the biggest challenges we're seeing is we're planning to refi the deal, and it become apparent that refi is difficult. It's possible, but it's difficult. So the decision may be to sell. So this is where you, as an operator, if you're running assets in your fund and you have some assets you bought 2-3 years ago, and you were thinking to refi now, and the refi makes a lot less sense, then maybe a flip and an exit is the right way to go. So case by case, I just wanted to point out the decision is not a binary decision. It really depends. And most investors should be very prudent. They should look asset by asset and figure out, for this asset, the decision is to refi, and for this asset, the decision is to sell. And for this asset, it might need actually more capital to get it to a full stabilization, and then you may be able to sell for a better price.
Great point. Great point. All right, guys, another great episode of PFREI. I'm your host, Fuquan Bilal. Today we have Mike Zlotnik. Make sure you guys go out to Tempo. Check out tempofunding.com. Oh, man, it was a plum-pleasing pleasure speaking to you today, my friend.
Thank you, Fuquan. Yeah, the easiest way to reach out is bigmikefund.com. And if you misspell it, you forget the D at the end, bigmikefund.com. I promise it's not a kinky site.
All right, guys, be sure to check us out on YouTube. Make sure you like and share and subscribe. And you can catch us on all those other social media channels. I'm trying to get the iHeartRadio. One day I'll be one of those podcasters on iHeartRadio. All right, guys. So I'll see you at the next show.